We talked about share class a little bit. I tried to bring that into the conversation. Granted, share class shows up in the outline for this exam twice, so it actually is a concept that we talked about before. But within this section, just this idea, don't forget, so we make a little chart, right? Class A shares, Class B shares, and Class C shares. Which one has a front-loaded sales charge? Yep, Class A. Which one has the highest 12B1 fee? Class B. Which one has schedules of breakpoints? Class A. Which one is always the back-end load? Class B. Which one converts to A shares? Class B, over whatever the time period is as described in the prospectus. Converts to A shares. So that leaves us with C. So C is just kind of another choice. So may be front or back end load, middle 12B1 fee, and never converts. So of these three, which one has the lowest 12B1 fee? Class A. So if you have a client and they want to get into the growth fund, no matter which class of share they choose, they're going to be exposed to the same portfolio of assets. So their share is going to be exposed to the same thing no matter what. What's different is the expense structure. Was there a sales load taken off at the beginning? Class A. Or granted, it could have been Class C. Back end load, most generally Class B. Highest 12B1 fee, so it's just different in the loads and expenses. Classes of fund shares. And we talked about within the realm of suitability, which one's best for which person. So if a person's going to put in a lot of money all at once, which one's best? Because of the breakpoints, generally speaking, Class A will win. Somebody's going to put in a bit of money at a regular basis over a long period of time, doesn't plan on selling their shares anytime soon, I would choose Class B. Even though in the real world you might not feel like that's the best choice, for the purposes of this test, please use that rule. So how do these quantity discounts, these breakpoints work? So we said, generally speaking, you're going to find breakpoints in Class A shares. So we have a hypothetical schedule of breakpoints within the PDF. So this idea that whatever the breakpoints are, they will be disclosed in the prospectus for the fund. Breakpoints are available to any person as defined in the prospectus. Most of the time, an investment company will consider a family one person. So me and my minor children, we are one person. My husband and our 25-year-old son, no, not one person. He's an adult now. So a father and a 25-year-old son would not be considered a family unit. Only minor children are considered. Investment clubs. So I used to work at Motorola, and it was like every group of cubicles had their own investment club. It was kind of fun. I don't know if you see those in many places anymore, but Motorola had a bunch of them. Investment clubs do not qualify for breakpoints, but retirement accounts do. So if you have a simple plan where you work based upon the aggregate invested dollars of everybody within the simple plan, we have reduced sales charges over time. So retirement accounts do qualify for breakpoints. So based upon this example, we've got investments of $1 to $24,999 has a 5% sales charge. If you put in $25,000 to $49,999, and once again, this is just a hypothetical example, then your sales charge goes down. So let's say your client calls you up and says, I want to put in $23,000. You're like, yes, no. You can't do that. You'd be violating FINRA rules against breakpoint sales. So when someone's near a breakpoint, okay, you have to explain to them, look, you're just $2,000 away in my example from having, instead of a 5% sales charge, only a 4% sales charge. So it's in your best interest to come up with $2,000 more and get a reduced sales charge, because then more of your money is going to go to buy you shares and less is going to pay me. Good for you, bad for me, but that's what you have to explain to your client. And they say, yeah, nah, I'm just going to give you the $23,000. That's all I have, and that's fine. Well, you have to explain to them, well, if you don't have enough all at once to qualify for a breakpoint, you can sign what's called a letter of intent. So what the letter of intent says is, I'll take your money today. So in my example, your $23,000. You have to agree over the next 13 months to invest $2,000 more, or whatever it is that gets the person over the breakpoint. So in this case, an additional investment of $2,000 would get them to the $25,000 breakpoint, thus the reduced sales charge. And they say, still not interested, but thanks for trying, so fine. So a couple of weeks go by, and the client calls you back and goes, you know what? I came up with some more money. What can we do now? So they didn't sign the letter of intent originally. You are allowed to backdate the letter of intent up to 90 days. So it may be backdated up to 90 days. So as long as they call you within those 90 days, we can backdate it, take the money now, and make sure that based upon this example, their overall sales charge was only 4%. So that's how it would work if they didn't originally want to sign the letter of intent. Let's say that they did want to sign the letter of intent, so we don't have to worry about backdating it at this point. So they said, yes, I will sign, and I will agree that in the next 13 months I will give you $2,000. So what we do to this first initial investment is we charge 4%. We keep some shares in an escrow account, because what if they don't come up with this additional $2,000? Then they owe you 1% more in commission. So we keep some shares in an escrow account just in case they flake out on this. And then there's this idea of the money that goes to fulfill the letter of intent must be new investment dollars. You cannot use reinvested dividends and capital gains to fulfill a letter of intent towards a letter of intent, and I'll show you why. The whole idea of a fund, when they allow you to automatically reinvest dividends and capital gains, they allow you to do it without a sales charge. Okay, and what's the point of the letter of intent? The letter of intent is all about a sales charge. So that would make sense that automatically reinvested dividends and capital gains would not count towards a letter of intent. So if the client had automatically reinvested $500 in dividends and capital gains and had signed the letter of intent to invest $2,000, how much is left to still invest? $2,000. It's all about a sales charge. So automatically reinvested dividends and capital gains do not count towards fulfilling a letter of intent. Breakpoints, like I said, most oftentimes seen on Class A shares. The right of accumulation. So not everybody is able to put in big chunks of money all at once, but after a period of time, right of accumulation. So just like before, where breakpoints are available to any one person, as defined within the prospectus, this would be true as well. So retirement plans also qualify towards the right of accumulation, where the balance over time gets to be big enough that they have a reduced sales charge. So allows the client to someday, instead of having a 5% sales charge, only have a 4% sales charge. And then someday it goes down to 3%. So how do we figure out whether or not we qualify yet for this reduced sales charge? The client may qualify for reduced loads at any time that the aggregate value of shares previously purchased and shares currently being purchased put them over a breakpoint. The investment company may base the quantity of securities owned for the purposes of qualifying for breakpoints on the higher of current net asset value or total of purchases made to date. So what is this saying? We can either look at it as dollars invested, okay, dollars invested, or the current market value of the dollars invested plus current investment that you're making. We're going to choose whichever of these two things are higher, whichever is higher, to get to that reduced sales charge, whichever is greater. So if there's been a market contraction, the dollars invested are going to be greater. If there's been appreciation in the market, then the current market value is going to be greater. So it's whichever of those plus the amount of the current investment that's being made. When we get over, in that example, just once again, solely hypothetical, 25,000, our account balance gets 25,000 or greater, up to 49,999. Then we have that 4% sales charge. So the right of accumulation. Once again, to review, as far as if the fund wants to charge the maximum sales charge, 8.5%, they had to do three things. Allow for the automatic reinvestment of income distributions at net asset value, that's without a sales charge. They have to have a schedule of breakpoints, and they have to offer the right of accumulation. Right of accumulation. Those are the three things. If they don't, then the maximum sales charge that they can charge goes down to be what? Do you remember? 6.25. If not, all three. The combination privilege. Most funds will allow you to, if you're putting some money in the growth fund and some money in the balance fund, combine those purchases towards breakpoints, towards the right of accumulation. So you can't be putting money into mutual fund company A on one side and mutual fund company Z on the other. It's within the same family of mutual funds where that most of the time the fund will allow you to combine your purchases. I talked a little bit about the exchange privilege already. The exchange privilege is something to be very careful with, making sure that your client understands. So let's say they got into the growth fund in 1990 when the bid price was 9 and the ask price was 10. Okay. Oh, I guess that wouldn't be possible. Let me use different numbers. I don't want to confuse you with not realistic numbers. Let's say 10 and 950. This is something the test likes. In 1990, what did you pay to buy your shares? You always pay the most. And then in 2000, it says you decided to switch. You wanted to get into the balanced fund. So in 2000, the bid price was 22 and the ask price was 23.12. So you buy at the ask, and when you redeem, you get the what? So just remember, you pay the most, you get the least. Isn't that how it always works, right? You pay the most, you get the least. So that you're able to take this value, net asset value per share, and move it into the balanced fund, also at NAV per share, which is another way of saying without a sales charge. That is the privilege, that you can go into this other fund within the same family and not have to pay a sales charge. But along comes the IRS and says that for tax purposes, this is a sale and repurchase. So that you have, in this example, you paid 10, when you exchange, they're worth 22. You have a $12 per share long-term capital gain. And I forgot to tell you that you had 100,000 shares. So people can create a significant tax liability without actually receiving any of their own money. If they don't realize what they're doing, they're going to be really angry when tax time comes along. So they need to be aware that it is a taxable event. The privilege is that there's no sales charge when they purchase the fund that they're exchanging into. That's the privilege. Most people that I know that have had this happen to them, they said if somebody would have explained it to me, I wasn't that unhappy in the first place. They never would have switched. Redemption of fund shares. We talked about this before, that mutual funds by law, open-end funds, must redeem an investor's shares within 7 calendar days of request for redemption. At what price? At the price next determined. So at NAV per share next determined. So it's always forward pricing. So if the request was received after market closed on Friday, we won't know what the price will be until Monday. So next calculated, forward pricing. With an open-end share, we redeem the share. Nobody else will ever own it. So it's like the transfer agent takes it, rips it up, and throws it in the garbage. That's their job, to issue and redeem shares. So unlike a closed-end fund or an exchange-traded fund or a share of stock that trades in the secondary market where we can change who owns the share, on an open-end fund, nobody else will ever own your shares. It's a continuous primary offering. As such, you can never purchase open-end mutual fund shares in a margin account. A margin account is where you borrow money from the broker-dealer to buy the shares. You can never buy new issues in a margin account. So open-end mutual fund shares can never be purchased in a margin account. These are always new issues, so you always have to give out a prospectus. Some mutual funds, when the account balance gets big enough, will offer for the client the right to select a withdrawal plan. A withdrawal plan. The SEC wants to be really careful that nobody gets confused with a withdrawal plan and an annuity. So the annuity product, somebody annuitizes, gets paid a dollar amount monthly for life. Not the same thing as a withdrawal plan. When somebody starts a withdrawal plan, if the fund even allows it, no more putting money in. That would be a really bad idea. You never want to be redeeming and purchasing shares at the same time. There's different types of withdrawal plans that may be offered. A fixed dollar, fixed percentage or share or time of withdrawal. All withdrawal plans pay out monthly. That's important to remember. So if it's a fixed dollar plan, let's say you want $500 a month, every month they will redeem a different number of shares. Potentially at some point you will run out of shares. Depends upon the market conditions how long the money lasts. Fixed percentage or fixed share plan. So you say every month redeem me 10 shares. Every month, the value of those shares will change, so every month your check amount will change. You could also say redeem 1/10 every month or whatever it is you choose. So if it's a fixed percentage, because the assets are going to be changing every single time they send you money, how much you get every single month is going to change. Fixed time plan. If you want to get paid monthly for the next, let's say 10 years, every month they would liquidate 1/120th, 12 months in a year, 10 years, right, 1/120th. Every month you'd get a different amount because the actual share price fluctuates every single day. There has to be a certain dollar amount before any fund would ever let you start a withdrawal plan. So you can't have a withdrawal plan with $1,000 in your mutual fund account. There's a limit as low, how low can it be? It would vary by fund. Maybe it's $100,000 or something like that. The fund will discourage purchasing shares at the same time that you're redeeming them, since you're always redeeming at NAV and purchasing at the public offering price, which is a net loss situation. Most withdrawal plans are offered as a free service by the open-end investment company. They are not annuities. They are never guaranteed at all. The SEC wants to make sure that these benefits are never misrepresented. The client needs to understand that it is possible that withdrawal plans will be exhausted over time, that there is no guaranteed rate of return. There must be absolutely no use of charts in regards to withdrawal plans unless they are specifically cleared for use by the SEC. Now, I want to do one last thing to kind of tie everything together. It's interesting how the outline is written, where we have product knowledge in one section, but taxes were in another section. So I want just to do one last chart for you. I can't help it. It's in my nature. So I have to. Here's one last chart, and then we'll move on to contractual plans. So here's the mutual fund itself, run by a board of directors. And the portfolio, who is it that determines what to buy and sell within the portfolio? Whose job is that? The investment advisor, right? And how do they get paid? A percentage of what? Assets under management. And they are the largest expense of the fund. A percentage of assets under management. Let's say that this is a balanced fund. What do we find in the portfolio? Stocks and bonds. And the fund itself has a little income statement. It has what's called gross investment income. What is gross investment income comprised of? We've talked about it, but I want to tie it all together. It's comprised of the interest from the bonds and the stock's dividends. So dividends plus interest. Then what we're going to do is we're going to subtract from the fund operating expenses. What's the expense that's the trailer fee? It's used to pay for distribution of shares. What's that called? 12B1 fee. Yes. Some funds have it and some funds don't. What's the largest expense of the fund? Investment management fee, investment advisory fee. Who safeguards the assets? The custodian. Who issues and redeems the shares? The transfer agent. Now, we talked about previously the idea of what's called Internal Revenue Code Subchapter M, what's called the conduit theory. And we said that in order for the fund to avoid paying taxes on what is their net investment income, so that's gross investment income minus operating expenses, Internal Revenue Code Subchapter M said that the fund had to distribute a minimum of 90% of the net investment income down the conduit through the pipeline to the shareholders in the form of dividends. And dividends may be paid how often? At most, yes, quarterly. So I just want to tie together all these random things that we've learned throughout the course. Now, if you bought the fund on December 1st, it's very common that in December, mutual fund portfolios make capital gain distributions. So you bought your share on December 1st, and on December 15th, they made a capital gain distribution of $3 a share. Remember, the portfolio can only do this one time a year. Do you owe taxes on the capital gain distribution? I mean, you just bought the share 15 days ago. Yes, it's not your holding period. The capital gain distribution is made because the fund itself owned securities, netted its gains against their losses, and still had gains, and distributes them to the shareholders so that the shareholder ends up having to pay taxes on those. So yes, I don't care that you only had the shares for a few days. Capital gain distributions can be made by the fund at most one time a year, dividends at most quarterly. Is a load an operating expense of the fund ever? No. So that when we have bid plus sales charge equals the ask, what is this? An open-end or a closed-end fund? Open-end. And what kind of shares trade in the secondary market? Closed-end shares as well as exchange-traded funds today. Okay, that makes me feel better. There's so many little bits and pieces. I just wanted to make sure to give it all a summary. A fast summary, I know, but just to make sure that I picked up. Some of those things came from other chapters, but hopefully that was helpful. Contractual plans. So contractual plans, these are sometimes called periodic payment plans. Periodic payment plans. These are our UITs. Unit investment trusts. So what they are is this contract where somebody agrees to invest $100 a month for the next 10 years or something like that. An investor signs a contract saying that they're going to do something on a regular basis over a period of time. Now, if you were the investor and worried, what if I was to die tomorrow, who's going to complete my plan? There is plan completion insurance, which is actually a type of decreasing term, kind of like credit life is sold to you when you have debt, credit card debt. Plan completion insurance in the event of your untimely death before you fulfilled your contract pays off your contract. But in actuality, nobody can force you to complete your contract. It's just you might want to do that as kind of a planning tool for your heirs, if you will. The actual contract itself is only really legally binding on the insurance, on the contractual plan that issued it, not on the client itself. So you can buy plan completion insurance if you were worried about that, or sell it to your client. So what ends up happening is the contractual plan asks that an investor make a fixed investment over a period of time. So let's say $100 a month for 10 years. The customer is purchasing fund shares from a plan company that holds the shares of a mutual fund in trust. So this is where we find the unit investment trust. So we have really what ends up happening is we've got the trust level and we have the fund level. So whenever you sell a unit investment trust, you have to give out two prospectuses. I never know how to say that. You have to give out two prospectuses. So the trust owns the shares of the fund, not actively managed. We talked about that. If it was actively managed, it'd be called a management company, but this one is not. Now, interestingly enough, contractual plans are governed under the Investment Company Act of 1940 and a slightly different set of sales charge rules. So on the test, you have to be really careful. There's two questions that they can ask you. For an open-end mutual fund, FINRA has an 8.5% maximum sales charge rule. For a contractual plan, unit investment trust, we have a different rule. We have the Investment Company Act of 1940, and the maximum sales charge allowed is 9%. It doesn't sound dramatically different, and it's really not. But if you don't read the question right, you can miss it, and it's an easy question. So you want to read the question carefully. And I'll show you where it can be greatly different, actually. So in and of itself, it's not that big of a difference. So FINRA rules 8.5%, Investment Company Act of 1940, 9%. So what I end up doing here is I make a little table of some sales charges that you need to know, and I'll explain what they mean in a sec. So we've got 9% on the top, and then on one side we're going to have 50%, and on the other side we're going to have 20%, and below the 20 we're going to have 16, and next to that we're going to put 4 years, okay? And I'll explain what all this means. So a contractual plan over the life of the plan can never charge more than a 9% sales charge. But it can be set up either as a front-end load or as what we call a spread load. The front-end load is obviously worse. So what this means is that of the amount invested in year one, the maximum sales charge that can be charged is 50%. So, for example, if the client, like I had said before, is going to invest $100 a month for 10 years, okay, that's $1,200 a year. So in year one, if it's a front-end load, how much can go to pay the sales charge? Yeah, that's a huge amount. That is dramatically different than the 8.5% sales charge rule. So it's 50% of the amount invested in the first year. So what that would leave in this example is in years 2 through years 10, the ability to pay out at most, right? What's the most we can pay out over the 10 years? 9%. So this is a way that gives people incentive to sell it for sure. So $12,000 is what we're investing. 9% of that is the most that can be paid out over the 10 years. So that's a significant difference. The spread loads, not quite so bad. So the spread load says this: in any one year, the maximum that we can charge as a sales charge is 20%. So 20% of the amount invested. So based upon this example where we're investing $1,200 a year, in any 1 year, the most we could charge would be $240, okay? $1,200 times 20%, $240 for a commission. However, we cannot exceed 16% over the first 4 years. So you have to look at the amount invested over the first 4 years, look at 16% of that, and then make sure that over the first 4 years, the sales charge paid out is not more than 16%. So it's not as dramatic as this 50% front-loaded sales charge. Over the life of the contract, what's the maximum that they can charge? Still 9%. So in the end, the result is the same, whether or not it's a front-end load or a spread load, but the major difference is, you've heard that, right? When you invest, the longer the money's invested, usually the better as far as compounding returns go. So that if you're really significantly decreasing the amount that they can invest the furthest to go, that's really detrimental to a client's return, potentially. So what do I need you to do? It's not really a math test, so that became a big mess, I know, I'm sorry. Know this, write this on your scratch paper. So we've got 9%, we've got 50%, we've got 20%, 16%, and then I put the little 4 next to it to remind me. And know that we're talking about here contractual plans, unit investment trusts. So whether or not it was front-loaded or spread-loaded, we had the same 9% sales charge that could be paid out. It was just a matter of when was it actually paid. Because sales charges are so heavy in the early years of this contractual plan, these companies must offer a refund of sales charges should the investor decide to terminate the plan early. So both plans, both the spread, that doesn't go there, and the front-end load have to have a 45-day free look. So front load and spread, they both have to have a 45-day free look, where if the client wants out of either of these in those 45 days, they will get a refund of net asset value plus all sales charges, So it doesn't necessarily mean they're going to get all their money back, but they're going to get all the sales charge back and all of their net asset value. So that's for both of these, it doesn't matter. NAV plus sales charge. It's this front-end load that has an additional refund provision, 45 days up to 18 months. If the client wants out, they're going to get NAV per share plus a refund of sales charges in excess of 15%. So basically that means that the most that they can keep, that they could be charged as far as the sales charge goes, if they want out of a front-end load from 45 days up to 18 months, is a 15% sales charge. On a front-end load after 18 months, if they want out, they just get NAV per share. The spread load only has the 45-day free look. So on the spread load after the 45 days, if your client wants out, they will get NAV per share.